This is Bloomberg Surveillance, Early Edition, with Francine Lacqua.
Good morning, everyone, and welcome to Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London, and here's what's coming up on today's program. Pressing the pivot, Asian stocks and commodity currencies rise as China accelerates the easing of COVID curbs across cities, including Shanghai. Crude maneuvers while Russia rejects the EU price cap, oil gains and optimism over China's reopening, and as OPEC Plus keeps production steady. And the Wall Street Journal reports that Saudi Arabia's Crown Prince Mohammed bin Salman is preparing to take a stake in Credit Suisse's investment bank. So good morning, everyone. Let's first of all check on the markets. I have to say, if you're the Fed and if you're a Fed official right now, you would have looked at that U.S. jobs report on Friday and said that really complicates my life. After fighting inflation for a long time, that strong U.S. jobs number just makes it a lot more difficult on how they move forward. Now, two stories that European stocks are looking at, actually three. Let's put in oil and OPEC Plus. Over the weekend, not doing much, or certainly looking at the situation instead of putting more barrels or taking off more barrels. Then there's a story in China getting rid of COVID restrictions. Could that mean that we're going to see a huge demand in energy and commodities for China? And then the third story, of course, is U.S. jobs. So for the moment, European stocks pretty much unchanged. The dollar index, 1,255. We chose a Bloomberg U.S. dollar. We could have chosen euro dollar. Maybe we'll do it shortly. And then Bitcoin. Look, the trials and travails of Bitcoin is something that we focus on, currently at 17,358. Now, we did have quite a lot of PMI figures. All of them. Again, just a reminder, I know everybody knows, but anything below 50 means that there's a contraction. So if you look at the contraction, we saw it in France, we saw it in Germany, we saw it in Italy. Italy, though, coming in a little bit better than expected. Euro area, November services PMI coming in at 48.5 instead of the preliminary 48.6. So let's also have a look at whether it impacts the European map. But Germany, November services PMI coming in a little bit lower than expected. Again, it's just at the margins. And all of these PMIs are below 50. You can see the difference, for example, between a DAX down 0.2% and a FTSE that's gaining 0.1%. Reminder, this is a lot of energy resource companies actually listed in the FTSE 100. If you look at the FTSE 250, it's probably a very different story. Now, China's offshore yuan strengthened through the closely watched 7 per dollar level for the first time in nearly 3 months as authorities accelerated a shift towards reopening the economy. We're also joined now by Bloomberg's chief China markets correspondent, Sofia Horta Acosta. Sofia, thank you for joining us. When you look at this shift over the weekend, is it going to be a stop and start on COVID restrictions, or do you think that this is a real game changer for the economy and for stocks?
It really is, Francine, the direction of travel that markets are betting on. And markets tend to price everything in advance. So there is obviously a lot of caution on the ground. When we talk to people on the ground, there's still a lot of restrictions on movement. But the key thing here and the key news over the weekend was, first of all, there was no unrest, no protests. And also that Shanghai, this is China's biggest, most populous city, but also, importantly, the city where that went through 2 months of really, really harsh lockdown earlier this year. The restrictions there are being pulled back. You no longer need a PCR test to go into a park or to use public transport. The expectation is that we'll get people consuming, moving around the city, and that's really boosting confidence in the market today. Francine, the Hang Seng Tech Index was up more than 9% today, and obviously the yuan breaching that 7 per dollar level. Why do we care? It's a key psychological level that's been the obsession of every currency trader here in Hong Kong and in China, mainland China, since the global financial crisis. So a really, really bullish start to the week here for the Asia session.
Let's also bring in our Kriti Gupta, our on-air markets correspondent. Kriti, when you look at global markets, and I want to ask Sofia specifically about some of the sectors and maybe some of the regulation that could surround, for example, gaming and others, but how is the China news going to impact the U.S.?
Well, it's hard almost to price it in because, once again, the timing is really a moving target. And what's struggling here is this even on the radar of the Federal Reserve? Because at the end of the day, that is what's driving markets globally. And right now, it kind of feels like it's a little bit of a blind spot. How do you price in something that is expected to happen potentially in March, potentially in June of 2023, at the same time as the peak policy rates from the Federal Reserve also overlap at the exact same time? So it really is a blind spot right now. And I think a great example of that is what you're seeing in the futures market today. Asian markets markets are rallying, they're ripping, they're roaring. Look at the futures in Europe, look at the futures in the United States, and that's really where you're starting to see pain, which tells you the Federal Reserve is the bigger overhang.
So, Sophia, do you see it as a little bit of a blind spot for the Fed, or is it just that it's very difficult to understand the China policymakers' thinking? Again, in the past, we thought they were reopening, and then they've gone backwards and forwards because of demographics. And how does regulation also play in?
I think you made a really good point there. How do you track the thinking, and also how do you track what's actually going on in the ground? And I think the big misunderstanding here is that there will be a reopening at a certain date and time. This is not how China does things. It's not going to be like in the UK where you had that big reopening party, COVID is over, Victory Day. That's not what's going to happen. So you have to almost track the daily changes in narratives and, really the minutiae of what's going on in Chinese cities, and that's really demanding for if you're in London or in New York. But the one question that everyone is asking me now is, what does this mean for inflation? If China does reopen, if we get a pickup in demand, and China is a big consumer of oil, a big importer of oil. What does this mean for the inflation story? Is it good for inflation? Is it bad for inflation? Where's that going to go? So I think that is the big blind spot, and there's still a lot of debate around what will happen if we do get that pickup in demand. The consumer story, I mean, in China, the consumer was already weak before COVID-0 really hampered or restricted movement. So it's also unclear how much of a pickup in demand we'll get. But really, I think that the point there is that the China story will be played, that macro story will be played more in Asia than probably in markets where you are and in the US.
Sophia, just very quickly, I know like in the last couple of years, we had, again, quite a lot of crackdown on excessive spending, on gaming, on celebrities, on kind of excess, also luxury spending and things that were not deemed to be, I guess, culturally of higher purpose. Is that changing in any way? And what does it mean for specific sectors?
Yes, conspicuous consumption is definitely not in fashion in China and hasn't been, especially for the past 2 years. I mean, common prosperity hasn't gone away. That's still the major theme under Xi Jinping, and it will likely be so in his third term. Stocks like Maltai, that's the big liquor maker where in big Chinese festivals, you give one bottle and they cost more than upwards of 1,000 yuan per bottle. That kind of regulation, cracking down on conspicuous consumption will still be a major theme. But really the premiumization, and that's a really difficult word to say, but it is a tag word that people like to use when they play the China story. The middle class, the Chinese middle class, that's still gaining in wealth, and that's the trajectory for the next 10 to 12 years, 1 to 2 decades. So that's still a big story coming into play. It's difficult to see where that's going to go next year, though.
Yeah, it certainly is. It's also difficult to know what happens to the U.S. jobs market. So you're the Fed right now, and you look at the hot jobs market. What do you do with it?
That's the question of the day. And I think, back to Sophia's original point on the commodity picture, that has to get factored in as well. And it almost feels like if you're trying to tackle a labor market that just won't quit, essentially, you also have to factor in a commodity inflation or price in the fact that eventually commodity inflation will actually come down in line with the rest of the economy. The problem is that's diverging right now. And we have no historical parallel to say, when has commodity inflation come down and the jobs market still stayed strong? That has never happened before, because traditionally they come in all together. And that's where the Fed has to write a brand new rule book about how to navigate this.
Yeah, and of course, the monetary policy transmission also takes time. So are they data dependent, or are they also, there's always a lag in what they did last quarter?
Well, they like to say they were data dependent, right? That's the buzzword of the last 2 years, essentially. But I think the lag is really where they are hitting a much more tougher spot. Because if you're looking at a lag of 8 to 12 months, how do you make a decision right now about whether it's actually effective or if you need more? And this PTSD, essentially, of the Volcker era of pulling back too early, that is still kind of hanging in the air. And I think that's where you're seeing divergence within the committee itself.
Yeah, and then you're seeing, of course, a change in dollar. I mean, on the data dependent, I think now what they look in the forecast is actually what they did last time. So again, it's kind of a lot more difficult to forecast what data does because of the hikes that they've implemented over the last 7 months.
Right, and the story hasn't really changed, has it? I mean, if you look at the last couple of months, we are still at very high inflation. We're still not seeing signs of that momentum that the Federal Reserve really needs for a proper pivot or even to utter the word of a Fed policy cut, for example, something that the markets are already pricing in. I think the game changer for the dollar, though, is that you're already seeing this kind of idea priced in by currency strategists that this is done. The peak policy rate is in. We're already pricing it in. And the big run that the greenback has had, that's priced all of it in into 2023. What happens when that turns around and you now look at a peak policy rate that potentially goes above 5.5%?
Sophia, what do you do with yuan right now?
Sorry, I missed you there, Francine.
On renminbi, what do you do with renminbi right now?
It is still relatively a dollar story. It'll be interesting to see how the PBOC reacts to this. It has allowed for more strength, and the key thing for the PBOC is not actually the kind of round number anymore. It's the pace of gains. The PBOC, though, is a lot more interested in how the yuan is faring compared to the trade-weighted basket. That's the basket of 24 trading partner currencies, and that's the euro, the pound, the yen. Those currencies are really the biggest driving force. We do get trade data this week on Wednesday. Let's see how China's import and export growth is. That could really change the outlook for the currency. But right now, currency forecasters are looking at 7 per dollar handle. That's likely to stay until at least the end of the year, if not through March, when we get that economic growth target for the next year.
All right, thank you both for joining us. Our Bloomberg Chief China Markets Correspondent Sofia Orta-Costa and our on-air Markets Correspondent Kriti Gupta. Now, coming up, we'll get more on what's driving markets with LBBW Chief Economist and Head of Research, Moritz Kramer. I don't think he has a favorable view on investing in China right now, so we'll get to the bottom of why that is. This is Bloomberg. Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London. Now we're joined by Moritz Kramer, Chief Economist and Head of Research at LBBW, to talk about the markets, China, and that U.S. jobs report. Moritz, thank you for joining us. When you look at the U.S. jobs, how much of a nightmare is it actually for the Fed to deal with these hot jobs report?
Well, good morning, Francine. I think for the Fed, that made things a little bit clearer because there was a wobble in the thinking. And certainly the markets had made up their minds that we're close to peak time because peak inflation pretty much seems to be behind us in the US. But the labor market data was a stark reminder that we're not anywhere near yet. So the Fed is going to do what they said they would do. I think I expect sort of another 50 basis points, but they're close to the end because they started pretty early. So we're now at 4, probably there are 2 or 3 more hikes to reach like 5%. And then we're there. And then, you get this crossover point sometime during next year where the inflation rate dips below the Fed rate. And I think this is when we can start talking about rates going down, but not earlier.
Moritz, what happens to the dollar from now? So the U.S. dollar erasing actually half of this year gains as there's expectations growing that the Fed will temper rate hikes, and at the same time we're seeing a slow reopening of China.
Well, premature, if you ask me. I think this weakening of the dollar that we have seen is not based on fundamentals. So we at LBBW, we expect sort of that the parity line will be crossed again next year. And not by very much, but we see sort of the euro dollar at 97 cents sort of in the second quarter probably. And the reason is that in terms of the business cycle as well, we are sort of much harder hit in Europe, where I predict a real recession, not just like hovering around the 0 mark, whereas the US is probably able to escape that fate, not by a wide margin, but still. And therefore, also what you see in the expectations of the interest rate declines in the US on the short end, that feeds into this weakening dollar. But by extension, if I think that the interest rate projection of the market is overly optimistic, then the same applies to the dollar rate.
But overly optimistic also about China's reopening prospects?
Yeah, now that's the big headline news, of course, over the weekend, and we're sort of devouring all the news coming out of there, trying to make sense. But look, Francine, at the bottom, nothing has really changed. The vaccination rate is what it is. Yes, they want to make an effort to vaccine the 80-plus cohorts, but that's going to take months. So, the Chinese leadership is now taking a big gamble by opening up because the infection rate, they will go up and there will be deaths. There will be many, many fatalities in the millions, probably, if you let this run, maybe in the dozens of millions. So he's sort of between a rock and a hard place now, Xi Jinping, of course, I refer to, because you cannot go on as you have right now, because this will just sort of not only harm the economy. I think he would be willing to live with that, but the risk to social stability is clearly visible on the streets. But if you open up too much, you might get the virus running out of control, and then you have to clamp down and lock down again, and that would be huge reputational damage. So the escape route for the Chinese leadership is extremely narrow here. So, and I'm doubtful they'll find that sweet spot, if it even exists.
Moritz, what happens to Europe, actually, in the next 6 to 18 months? I don't know whether we're overly optimistic about having peak inflation and being able to deal with the energy crisis.
I would think there is a lot of willingness in the market over here, this side of the Atlantic as well, to see things in a sort of with rose-tinted glasses. I know it's Christmas season as well. Everyone has a long wish list. But remember, as a child, you wrote this long wish list and not everything came true. And the same will be true for the markets. So no, we're probably not above the hump yet. We're pretty close. I would still think that into early 2023, we'll have two-digit inflation. But more importantly, inflation will come down, of course. But more importantly, we will have a recession. So for the Eurozone, we are predicting at LBBW a contraction of 0.8% over average next year, and for Germany about twice the size. And the reason is that we're much harder hit by this energy crisis, which is not going to go away anytime soon. So we're trying to mitigate. But for industry, and Europe is a very industrialized place, and Germany more than any, this is a big hit to competitiveness. And of course, consumer confidence is at an all-time low. So I would be really surprised if the positive and optimistic market expectations about the macro environment would really come true.
All right, Moritz, thanks so much. Moritz Kramer, their chief economist and head of research at LBBW. Very grateful you're joining us this morning. Now, coming up, Wall Street banks slash bonuses as the talent war appears to be coming to a close. Well, more on that later in the program. And this is Bloomberg. Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London. Now let's get straight to the Bloomberg First Word News. Here's Leanne Gerrans. Hi, Leanne.
Hi, Francine. Chinese authorities have eased COVID testing requirements in several major cities over the weekend. Shanghai, which saw a grueling 2-month lockdown early in the year, has scrapped PCR testing requirements to enter outdoor public venues such as parks or to use public transportation. Hangzhou, home to tech giant Alibaba, has also dropped testing requirements to enter offices and also supermarkets. Now, South African President Cyril Ramaphosa's lawyers will challenge an advisory advisory panel's report that said there may be grounds for his impeachment. The panel said last week the president may have committed serious misconduct and constitutional violations. This as the governing ANC's top leader hold a crucial meeting on how to respond to the report's damning findings, which Ramaphosa does deny. The UK's RMT union has rejected an offer aimed at ending rail strike action planned before Christmas. The union says a pay rise of 4% this year and another 4% in 2023, along with reforms to working practices, is just not acceptable. Rail workers who plan strikes on 8 days in December and January join a growing wave of workers taking industrial action in the UK over pay. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Leanne Gerrans. This is Bloomberg. Francine.
Leanne, thank you so much. We continue looking at onshore yuan extending gains about 1.5%. That's the most in 3 weeks. Now, this is, of course, their optimism continuing, and that's boosting the currency. The yuan surged past the key level of 7 per dollar earlier in the session for the first time since September. Coming up, we talk China, we talk oil, we talk OPEC. This is Bloomberg. Pressing the pivot, Asian stocks and commodity currencies rise as China accelerates the easing of COVID curbs across cities, including Shanghai. Crude maneuvers, Russia rejects the EU price cap, oil gains on optimism over China's reopening, and as OPEC Plus keeps production steady. And the Wall Street Journal reports that Saudi Arabia's Crown Prince Mohammed bin Salman is preparing to take a stake in Credit Suisse's investment bank. Now, good morning, everyone, and welcome to Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London. Let's get the latest on oil now. A Kremlin spokesperson says Russia will not accept the $60 per barrel crude price cap agreed upon the European Union on Friday. Now, the price is higher than where Russia already sells most of its crude. The EU and G7 cap actually aims to hit Russia's revenue by stopping access to shipping and insurance for oil purchased above the price level. Well, today, the EU's ban on seaborne oil imports actually also come into effect. Now, for more on all of this, we're joined by Bloomberg's Europe correspondent Maria Tadeo. Maria, good morning. So we have these sanctions on Russian crude exports taking effect today, as well as the agreement on the oil price back. So how big of an impact could these actually have?
Yeah, and it's a big day, Francine, because remember, there had been talks and weeks and a big diplomatic spat back and forth over the price of this oil cap, and it has now settled and gone effective at $60 a barrel. Today, you also have this full ban on Russian seaborne oil coming from Russia, of course, into the European Union. European officials and the institutions today saying this will do or will inflict severe damage on the Russian economy as the war in Ukraine continues, and immediately that response from the Kremlin suggesting they are not going to accept this and will not sell to any country that participates in this G7 oil cap. Now, the question going forward, of course, is will it work? Is this going to be successful? Will it be a flop? Can you get around it? And Francine, that's a question that I put to a lot of contacts over the weekend, and the general response that I got is wait and see. This is a big global industry. Of course, there's a lot of players that are involved here. You assume that everyone would play by the rules, but sometimes we know in real life that doesn't happen. So the overall response is let's wait and see and keep a very close eye, in particular, on the insurers.
So meanwhile, tensions between the U.S. and the EU continue over trade. What's the latest?
Francine, this is the biggest story. Of course, we have to put Ukraine aside. Ukraine is a dominating story on everything across the geopolitics in the world, of course. But when you look at the Brussels institutions, the Inflation Reduction Act, this is right now top of the agenda for most officials. They do believe this could become potentially a big trade irritant. They fear potentially a trade war between the United States and the European Union. Yesterday, we heard from the head of the Commission, Ursula von der Leyen, once again warning that it has created distortions in the market, that there needs to be a level playing field. And she also suggested, and this is where it gets very interesting, that the European Union could also change some of the state aid for its companies as a response to the Inflation Reduction Act. This is also an important week because the Trade and Tech Council will meet. Of course, that brings the United States and the European Union together, and that statement is now closely monitored to get a sense as to whether this escalates or actually will they find common ground and avoid anything that looks like a trade spat between the two.
Maria, thank you so much. Maria today there with the very latest out of Brussels. Now, the Wall Street Journal is reporting Saudi Arabia's Crown Prince Mohammed bin Salman is preparing to invest in Credit Suisse's investment banking unit. For more on all of this, we're joined by our Swiss banking reporter, Marion Halftermeyer. Marion, thank you so much, as always, for joining us. This feels like a very significant deal. And also, Michael Klein had personal ties, actually, to the Saudis, also when he worked at Citigroup as a rainmaker. So how much do we know this is a, I guess, sign of confidence in Michael Klein? How much of it is in Credit Suisse?
So, Francine, the bank has guided that they've been talking with different potential interested parties for the Credit Suisse First Boston spin-out. So this is the first name we've sort of seen come out. But let's put this into context. The Saudis have also expressed interest in being a key anchor shareholder. They're participating in that $4 billion capital raise through the Saudi National Bank. So there's a lot of interest around the Saudis, and the Qataris have also long been invested in Credit Suisse. So it is a sign of we're going to stand by Credit Suisse. We're interested in different parts of Credit Suisse.
So how big of a deal, Marion, what are we talking about? Like, how much money is it, and does it make a difference to international shareholders? Is it, if it's a Saudi investment, firm, or whether it's the Crown Prince himself?
So I think from a figure perspective, we're looking at $500 million. Now, the bank had already guided that they had an interested party for $500 million as well for just the Credit Suisse First Boston part. So it's unclear whether that's the same $500 million or not. I think from an international perspective, it doesn't necessarily cause a deterrent. I mean, everyone has long known that Credit Suisse has had Middle Eastern backers. So it's just a matter of how that investment is put into play, whether they get a board seat, and then all that is very unclear because we don't really know yet how Credit Suisse First Boston is going to look like once it's carved out of the larger bank.
Marion, when do you see the share price? So there was a huge reaction on Friday. There was another reaction today for Swiss banking. Is it too soon to say that investors are getting behind this because of the capital raising?
It's unclear. I mean, they've certainly been able to break the losing streak that they've had. It was really historic and getting a little scary. I think a lot of people were getting a little nervous. But now it's a telling sign that maybe they've put their money where the mouth was, where they've raised the capital, they've had a debt issuance. And so things are looking a little more stable. The chairman guided that liquidity was getting back to normal or closer to normal, so that's also helpful. And they're obviously looking at trying to get some of the asset outflows that they've had come back to the bank. So there are some positive signs emerging. It'll be, we'll have to see how the year caps out and what will happen next year.
Marion, talk to us a little bit about some of the other anchor investors. So there's also a Saudi bank. We know that David Harrow of Harris Associates has a big chunk. I mean, do you expect a lot of the shareholding to move with the share price dilution?
It's interesting. I think we will probably see some of the main shareholders, including David Harrow's Harris Investments and the existing Qataris who have about a 5% stake, probably keep their stakeholding. I think we're going to see them participate again. I think the bank has guided that their existing shareholders are supportive, and so we'll see them show up, I think, in the cap stack once we get that. As for the rest of the investor makeup, it's historically been very Swiss held as well, so anticipate that to continue because you have a lot of caps on investment and pension funds having to invest in Swiss stocks as well.
Great. Thank you, as always, for some great reporting. Of course, our lead reporter on some of the Swiss banks, including Credit Suisse, Marion Halftermeyer. Now, coming up, could Europe become one of the world's largest legal cannabis markets? We'll get more on that and the drug's medical uses in the continent. That's coming up next, and this is Bloomberg. Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London. Now, the use of medical cannabis is on the rise. Independent investment bank Bryan Garnier sees Europe's illegal cannabis market growing by 62 billion euros by 2032. That's up from only 700 million euros this year. We're now joined by Nicolas Weiss, the senior research analyst for beverages, cannabis, and agri-tech at Bryan Garnier. Thank you so much for joining us. I mean, first of all, I was in New York just a couple of weeks ago, and it's amazing. You just smell weed everywhere. You walk, and at first, you need to get used to it a little bit. Where do you see, in terms of regions and countries, the biggest growth for this market?
Well, it always starts with medicinal cannabis, and that is what we've seen also what we're also seeing in Europe. We've seen Germany introducing medicinal cannabis in 2018. UK also 2018.
So this is CBD, right?
No, medicinal cannabis. Okay. That's separate from CBD. Yeah, CBD market is different from the cannabis, medicinal cannabis, or the recreational cannabis market that we're.
Yeah. So if you look at CBD and if you look at medicinal cannabis, are the two linked? If there's one, is there going to be an increase of the other one because regulation in general will open up, or are they completely different markets?
They are different markets. CBD is much more wellness-based, whereas medicinal cannabis is more for certain therapeutic benefits that you want to achieve.
So which one's bigger? Which one can grow bigger?
Oh, the medicinal cannabis market, without any doubt. For Europe, we are expecting that this market can go to 10, 12 billion euros in 5 years' time. Yeah.
And this would be what, thanks to regulation? So it has to be doctors that prescribe it,
absolutely. Right? It's currently the regulations are very limited and very restrictive, and that is also because the health authorities, they need to have proof that something is working. They need to have hard evidence on therapeutic benefits trials. Otherwise, they will not allow this product to be promoted to their patients. But all these countries are currently in the process of setting up trials or doing trials, including UK. In the UK, we have now 15,000 patients who are in clinical studies and where regular feedback is given to the NHS on how these trials are going.
So, Nicola, talk to us a little bit about who makes this medicinal cannabis. So is it companies outside of Europe? Like, who would benefit when this really expands and increases fivefold?
Well, there are different type of companies who are producing this products or selling these products. Obviously, the North American companies, where you already have a medicinal and adult use market, are also producing medicinal cannabis and exporting it to Europe. Next to that, you have venture capital-based European companies who are being set up to produce and to sell medicinal cannabis. And next to that, you have also a couple of companies which are already on the stock market quoted.
So does it replicate basically the growth that we've seen in the US?
With a certain delay.
2 years delay?
Well, maybe even 5-6 years delay. I believe in the recreational market of cannabis in Canada was agreed in 2018. You have in the US, you started gradually seeing the states introducing medicinal cannabis, starting with California in 1999, recreational from 2013 onwards. So we are now starting in Europe, so it's like nearly 10 years later. But that legalization is spreading across the globe. And
So Nicolas, talk to me a little bit about CBD. This is for wellness, so it's not necessarily recreational, right? How do you define it? And I was interested in your research in reading that actually the UK has the biggest potential for CBD user, which values at around 150 million pounds.
Yeah. There are three big product categories in CBD. First is the oils, the tinctures, and they are being sold here in the UK. You have novel foods, CBD in food, which is currently held back by the European regulators, and because they need to have safety tests showing that it is safe for people to consume, obviously. And then next to that you have the flower itself, the smoking of the CBD flower, which is a very large market in those markets that allow this type of product. That's, for example, France, Switzerland, Austria, Belgium, who allow the CBD.
So when you look at, Nicholas, and I was really interested, the top 5 European markets, Germany, France, Italy, Spain, and the UK. Again, if you look at timelines, so is the UK just more advanced in terms of liberalizing, in terms of usage, than the rest of Europe, or do you think it's just going to be a vastly different market?
No. The countries that are most advanced in Europe is Israel, it's Switzerland, it's Germany, Malta, Luxembourg, Portugal. UK is a little bit behind, and especially currently, it's everybody's probably looking at what Germany is doing. Germany has asked the European Commission if it can put a recreational market in place in Germany, and it has its own legal implications that it is trying to solve. And I suppose that is where everybody will be looking at how Germany will be solving these problems. And UK, France, Spain are expected to come in more in like a second wave, say in 3-4 years' time, before they start allowing recreational cannabis.
Nicholas, thank you so much for joining us. Nicholas Fesch there, a senior research analyst for beverages, cannabis, and agri-tech at Bryan Garnier. Now let's get straight to your Bloomberg Business Flash. Here's Leanne Gerrans. Hi, Leanne.
Hi, Francine. Sam Bankman-Fried says he will testify before the U.S. Congress. The chair of the House Financial Services Committee invited the founder of collapsed crypto exchange FTX to join the panel's hearing, which is scheduled for next week. Bankman-Fried says he will appear after he has finished, quote, learning and reviewing the events that led to the implosion. He says he is not sure that will be in time for the hearing. Now, Elon Musk says Apple has fully resumed advertising on Twitter, further de-escalating a brewing war between two of the world's most influential tech companies. Musk made the comments during a Twitter Spaces conversation over the weekend, adding that Apple is still the largest advertiser on the social media network. And Archegos founder Bill Wang has asked a judge to dismiss fraud charges against him. He alleges that prosecutors engaged in what he calls deceitful conduct in the early days of the investigation. Wang says he was duped into assisting investigators who gave him a false hope that he won't be charged. He's scheduled to go on trial next October over the collapse of the capital management company. And that's your Bloomberg Business Flash. Francine.
Leanne, thanks so much. Coming up, Wall Street banks slash bonuses as the talent war appears to be coming to a close. More on that next. And this is Bloomberg. Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London. Now, just less than a week ago, Wall Street's biggest banks were locked in a vicious bidding war for top talent. Now, not so much. Now, a slump in deal-making and 2022's market swoon are threatening bonuses and even pay. That's our big story. Today, we've been following it very closely. It seems that over the last 2 to 3 months, many banker bonuses were really about, trying to retain or even trying to attract top talent. There is one man that covers it all, including the City of London. And of course, maybe we talk about the banker bonus cap here in the UK. That's been taken off. Joining us now is actually Bloomberg's Tom Metcalf. Tom, thank you for joining us. I mean, we're all obsessed by bonuses. I mean, we're not, but of course the people that get the bonuses are. So why are we hearing about, some of the big banks that presumably are making a lot of money in this period of volatility, slashing bonuses?
Yeah, it is the season for banker bonuses, so it's all people in the City of London are really thinking about right now. And yeah, the messaging is pretty downbeat, and for some that will be surprising because when we've looked at these quarterly results over the year, you've seen, Barclays traders do great, Goldman traders do great just because of the market volatility. But then last week we heard, hey, guess what? Even if you're a trader, you might be in for a bit of a nasty shock. Like Goldman, probably leader of the pack really on fixed income, etc., is saying, look, you're going to expect sort of low double-digit declines, which is a big surprise because normally, it's eat what you kill, right? It's if you perform, you'll do well. So to your question of why, I think it's twofold. One is, particularly the banks are still getting pressure on costs, obviously from shareholders and stuff like that. And this is, one of the big line items. So it's very difficult to get away from, not messing with this. And then secondly, it's more of a look forward, right? So yes, 2022, great year for trading, but it seems that a lot of the banks are now looking ahead to 2023, seeing tough times, and that all feeds into their calculation. And it's a calculation indeed on like sort of the war for talent, right? So if they think, you know what, we can pay a bit less and still keep people because there's fewer jobs out there, there's a bit less competition, then it's that kind of game of just trying to find the least they can pay and get away with, basically.
I mean, as our trader whisperer, Tom Metcalf, like, do traders kind of get mad because their bonuses are slashed and try and look for another job straight away? Or is it, again, how complicated is it finding a new job in this kind of environment? Like, should they worry about losing talent?
Yeah, look, I think the top performers, rightly, when they see probably stories like this, they get a bit antsy and wonder, hey, will I be rewarded fairly? Yeah. I think typically, there is it's a bell curve here, right? And I think if you've blown off the doors at your bank, then you'll probably still be okay because they'll be desperate to keep you. It's probably more the middle ranking traders or, obviously the underperformers are really going to get hit. So I think in terms of the process, whether they leave immediately or not, I mean, if I were them, I'd wait till I get my bonus, which is why they sort of delay it, exactly, February and March. And I think the banks would be hoping by that point, the sort of, maybe the messaging is a bit clearer, they've been able to keep people.
So who have we heard from Goldman's, I think JP Morgan, what does it mean for the poor European banks that even in the past couldn't really quite match up those salaries and bonuses?
Yeah, exactly. So Goldman came out and talked a bit about the traders. We also had Jefferies coming out and saying, hey, this is going to be a difficult bonus season. And so, that all feeds into the European banks' calculations. What we've seen at Barclays, for example, is we know they're cutting investment banking jobs. A couple of hundred roles might be up for grabs there. And we also have reporting that suggests that Barclays, along with plenty of other banks, is going to actually what we call bagel a few traders. So
bagel zero.
A zero, yeah. So if you're an
big
underperformer,
fat zero.
Exactly. So that is obviously a big message being sent to, which would be sent to those people. But yes,
but is that a message? I mean, when you get zero bonus, is it kind of, the message of stick with us, we're just going through tougher times, or we need to prove something to shareholder, or is it thanks so much?
Yeah, I think your
bye-bye.
Surplus to requirements is how at least I would interpret that.
It's us, not you.
I think, it's not a great look. I mean, even in the UK where you have a much higher fixed salary to bonuses is still a big chunk. It's huge numbers we're talking about. And I think, any sort of self-respecting trader, if they were bagel, as it were, would at least be looking for other opportunities.
Yeah. Tom, very quickly, I mean, we used to talk about Goldman Sachs, unlimited vacations. Is that no one ever takes, but is there something that they can offer in return?
I think
free energy?
No, I think ultimately for these traders who are in the office 5 days a week, they have to take a certain amount of holiday. I think it all comes down to the money.
All right, there you go. Tom Metcalf, there, our resident banker whisperer, joining us, of course, on everything on bonuses. Now, let's also take a look at some of the things to watch out for this week. Today, EU finance ministers meet in Brussels, where EU sanctions on Russian fossil fuels and the cost of living are likely to top the agenda. We'll have plenty of data from the U.S., including factory orders, durable goods orders, and the ISM services index. Tomorrow, we'll have the latest policy decision from the Reserve Bank of Australia. Also, Democrat Raphael Warnock and Republican Herschel Walker face off in Georgia's tight U.S. Senate runoff. On Wednesday, we have rate decisions from Brazil, Canada, and India. We also have Euro area GDP reading. Thursday, U.S. initial jobless claim are released. We hear from François Villeroy de Gallo of the ECB. And then on Friday, we'll have plenty of data on China, including CPI and PPI. Woo! What a week to get your energy up this Monday. More Bloomberg Surveillance Early Edition is up next. This is Bloomberg.
Once again, Fed communication has contributed to undue volatility in markets.
We got a long way to go to getting inflation down where the Fed has said that it wants it to be.
There is a slowdown coming through, and I think the Fed is acknowledging that, and that's part of the reason why it's talking about moderating the pace of hikes relatively soon.
This is Bloomberg Surveillance, Early Edition, with Anna Edwards, Matt Miller, and Kailey Leinz.
It's 10 a.m. in London, 5 a.m. in New York, and 6 p.m. in Hong Kong. Our top stories today. Backing away from COVID zero, China eases testing requirements in major cities across the country. OPEC and its allies hold steady. They decide to keep oil output unchanged in the wake of market turmoil and uncertainty. And Saudi Arabia's Crown Prince Mohammed bin Salman reportedly is set to invest in Credit Suisse's new investment bank that has shares rising in early trading. Welcome to Bloomberg Surveillance Early Edition. I'm Anna Edwards in London with Matt Miller and Kailey Leinz in New York. And Kailey, it seems that once again, the Asian equity session, sentiment lifted there by China reopening stories, but that's not really filtering through into the global narrative.
Yeah, it may not be spreading across the globe, Anna, but it definitely was a stark move in Asia overnight to the upside. The idea that COVID zero policy is starting to ease, with testing requirements easing over the weekend in cities like Shanghai and other places around the country as well. So that sent stocks up much higher overnight. MSCI Asia Pacific Index as overall up a little more than 1%, but really the outsized moves coming from Chinese equities that are listed in Hong Kong. The Hang Seng China Enterprise Index was up more than 5%, and tech stocks in particular up 9.3%. That Hang Seng Tech Index now at its highest, going all the way back to August. Meanwhile, for the Chinese yuan, it is at its strongest going back to September, breaking below that 7 per dollar level for the first time in about 3 months. 694.59 is where we trade on dollar offshore yuan at the moment. And then in the commodity complex, you are seeing some gains spurred by the fact that Chinese reopening demand fuels the optimism around the demand story. So iron ore up a little more than 2%. We're trading at $108, which also is the highest level going back to August, Matt.
All right, so we're looking here at futures that are actually down. You'd think the China reopening story, as Anna said, would spur bullishness around the world, but it certainly hasn't here. It looks like equities investors, at least in futures right now, are focused more on the Fed's rate path than they are on the possible demand that would be created by the reopening in China. So we do have a drop here, and we didn't actually have a big drop on Friday. So it seems like investors have spent the weekend kind of reassessing what they thought of the jobs number on Friday. But Larry Summers and a number of others have called for higher rates than the market is currently pricing in. So that could be what's happening here. The 10-year yield up a little bit, not too much though, almost 3 basis points, 351.33 is the level on the 10-year, although there are a lot of strategists saying, look, if we're going to go to a Fed funds rate of more than 5%, we need to be higher than 350 on the 10-year yield. NYMEX crude is where you see the China demand coming in, to some extent rising about 1.8% right now, 81.43. Of course, Brent is rising as well. And of course, we have other oil stories, what OPEC is planning to do, what the Russians think about the European oil cap, which has actually been set at a higher level than they're paying for oil right now out of Russia anyway. And then Bitcoin right now up a little bit more than 1%. $17,315, so back up above that $17,000 level after the terrible month that November was for certainly centralized exchanges. It doesn't look like it's hit the underlying asset too hard. Anna, what do you see in terms of European stocks and markets?
Yeah, we'll certainly get more on the Bitcoin story and decentralized finance later in the program. Another conversation about that. Matt, this is what we see for European equity markets. A mixed picture, flat to negative actually for most of these markets. The London market proves itself to be a little bit more resilient because of basic resource stocks going higher. We've got iron ore prices are higher, oil prices, Matt set out, those are higher. But perhaps that points to the negatives also for Europe, because if the China reopening story is going to quickly lead to higher commodity prices, then this is not a great time for Europe when it comes to commodity prices, given how stretched the gas story has been, dependent on the weather, of course. Brent crude is then at $87.09, 1.8% higher than previously. As Matt was saying, there's so much going on here. OPEC Plus deciding not to change their output plans, but there's a lot to talk about. There's the reopening in China. That, according to Amrita Sen, is the biggest driver of oil prices, and she thinks that pushes things higher at the start of next year or into next year. This is the gas price then, up by 3%. And I put this in here as an excuse to mention the story around Trafigura. So the German government has signed a loan agreement with the commodities trader Trafigura, and in exchange Trafigura promises to send a substantial amount of their US LNG product to Germany. And this is interesting politically, the way that Germany is setting itself apart here and doing a deal on its own. And it's interesting in terms of the market dynamics. The gas price in Europe then up around 3% today. Vodafone is up around 0.5%. And I put this in because the CEO is leaving. The stock is actually down 44% during his tenure. And so after 4 years, Nick Reed is going to be leaving that business. Credit Suisse up 7%. We mentioned this in our headlines, Matt. This is to do with whether we might see further investment coming through from Saudi Arabia. It is certainly being talked about in other media, and that is pushing the share price higher. It was higher on Friday, of course, after comments from the chairman.
Yeah, well, I mean, we know that Saudi Arabia already is taking a 9.9% stake in the bank. The question is whether or not, or the reports are that Mohammed bin Salman himself is going to directly invest in the investment bank as it gets spun off. Let's get, though, back to the China story right now. It appears to be shifting away from the strict COVID-0 policy over the last few days. This weekend, testing requirements were eased in a number of major cities. Bloomberg's Tom McKenzie joins us now for more. So, Tom, what changes have we actually seen, interestingly, really, since these protests took place a week ago?
Matt, I think you're right to focus on the protests. It's really fascinating that that outpouring of anger that we saw last weekend has appeared to move the dial. At least it's accelerated this shift by authorities and the officials in Beijing to put in place some real material changes. They haven't completely given up on COVID-0 yet. That may well be coming, but they have made material changes. For example, entering shopping malls, entering restrictions. You don't need to prove that you've had a COVID test. In fact, they've been removing a lot of the COVID testing facilities in some of these key cities, like Shenzhen, like Guangzhou, like Beijing, like Shanghai, and that continues. It's worth pointing out that there are still major parts of the economy that remain closed off. For example, the schooling system remains shut in large parts of Beijing. There is still a closed-loop system, for example, for factories like Tesla producing those cars just out of Shanghai. But these are significant changes, and of course the markets have reacted to that. Goldman Sachs saying they now expect fully a removal of these COVID-0 restrictions by April of next year, Matt.
And Tom, I know that we've done a survey of economists who, similar to that timing, are talking about the second quarter of next year, aren't they, for the lifting of the COVID-0 measures. So what is stopping China from reopening more quickly?
Yeah, a couple of factors. And again, you could describe these as own goals, arguably. So not allowing the import of mRNA vaccines, so Pfizer and Moderna, that we know are so efficient at reducing at least the transmission, at least the hospitalization and death rates. Those have been blocked so far by Chinese officials. We'll see if that changes. The relative low vaccination rate of the older population, particularly the above 80s, that is a factor as well. And the healthcare system as well. They need to ensure that the healthcare system is ready for a tick up in rates in terms of infections and hospitalizations. The other thing to watch for is there's the Politburo meeting in the next few days, and there's been reporting from others suggesting that you may get additional measures come Wednesday of this week. So watch for that as well in terms of further concrete measures on COVID-0 out of Chinese officials.
OK, Tom, thanks very much. Well, we'll look for that on Wednesday then. Tom McKenzie with the latest on China. Now, China's reopening is pushing oil prices higher. I spoke with the Energy Aspects co-founder Amrita Sen earlier on her predictions for oil in the next year earlier.
Just last week, you've seen 17 million barrels of draws across US, Japan and ARA. So draws are picking up as the SPR slows down. And yes, Europe and US will slow down. It's already in our numbers. But again, China and Asia picking up the baton will just create a lot bigger deficit. So some volatility in the near term, but then upward trajectory for oil prices should resume from next year.
Paul Wallace joins us now, Bloomberg editor for energy and commodities. Paul, good to see you. So how does the China COVID outcome then set us up for a rally in oil prices?
Hi, Anna. Well, that is definitely the main driver of oil prices right now. I think what we've seen in the last week...
All right, it looks like we're having a little bit of a difficulty there in terms of the audio. We're going to try and hook that up again and get back to him right now. But I want to get to the Credit Suisse story that Anna had mentioned earlier. Saudi Arabia's Crown Prince Mohammed bin Salman is preparing a direct investment in Credit Suisse's investment bank, according to the Wall Street Journal. Marion Halftermeyer, our Swiss banking reporter, joins us now for the details. So, Marion, it doesn't seem as though Credit Suisse really has a problem with Mohammed bin Salman and his money in terms of investing in CSFB.
No, not necessarily. And they've come out and said, look, that they welcome, diverse investors across the globe. They do have a broad base of investors. I mean, one of the other big shareholders is David Harrow of Harris Investments, for example. So it's not necessarily problematic from them. I do understand that people have raised this sort of geopolitics angle to it. But I think at this moment, they're just looking for strong backers with long-term money, and the Saudis are providing that.
Who are the other potential investors we should be keeping an eye on as well, Marion?
That's the tricky question. So there's two things going on here. We have the capital raise, which is obviously it's coming to a close at the end of this week, which we will see probably some of their main key investors, so the Saudis, the Qataris, David Hero, as I mentioned, reappearing as large stakeholders. And then you have the separate part, which is the Credit Suisse First Boston, which we're still trying to figure out, and they are themselves trying to figure out how they're exactly going to carve this out and what kind of equity ownership model they're going to have. I think Credit Suisse wants to keep a significant stake in that business, and they also want to create a partnership model for their main MDs, the main deal makers in the business. So you'll see Michael Klein come on as CEO. He's obviously a phenomenal historic deal maker from his time at Citibank. So he might take a stake, and then some of the other leading bankers will take some kind of a stake through the equity partnership. Then they're also looking for the outside capital, particularly for the leveraged finance business. So you might see any number of institutional players come into play. For example, we did see Apollo and PIMCO and a number of other banks looking at the securitized products group. So there's definitely appetite out there for pieces of Credit Suisse. It's just going to take a bit of time to figure out what that structure is going to look like.
Yeah, and the market increasingly pricing that in, up 7.5% then for Credit Suisse shares this morning after Friday's rally. Marion, thank you very much. Bloomberg's Marion Halftermeyer with the latest on Credit Suisse. Let's get back to the oil story. Paul Wallace, Bloomberg editor for energy and commodities, now fully on mic, I understand. Paul, you were telling us about how reopening in China is going to impact on oil prices. Amrita Sen certainly suggesting to me earlier that this was going to be the guiding factor early next year.
Yes, I think it's a guiding factor right now with oil prices rising slightly today, and yes, early into next year as well. This was the thing that oil markets had really been waiting for, this reopening of China, which could lead to a huge rise, a big rise in oil demand there of anything around 2 million barrels a day. So if China is intent on reopening quite quickly, and a lot of oil traders think that the signals from the last week or so suggest that, then yes, that could put more pressure on oil prices given how tight we are. The suppression of oil demand in China over the last year because of COVID-0 has really weighed on crude prices.
Well, and of course, the other oil story we have to consider is that EU sanctions on Russian oil start today. The bloc also has agreed to that $60 per barrel price cap. We just heard from the Kremlin, a headline coming out that Russia is preparing its response to the West oil price cap. Do we have any idea what that response could look like?
We have to wait and see, and I think even Russia itself will be watching to see just what the effect of this price cap will be on its exports, because even Russia doesn't know. I mean, these tightened sanctions and this price cap are pretty much unprecedented in the oil market. Russia has said very clearly that it is prepared to cut production and cut exports if would-be buyers are trying to impose this price cap on it. The good thing for the global market, and especially oil importers who want lower prices, is that the cap has been set at a level that is below where Russia's main grade is trading at the moment. So there are a lot of analysts out there that think it will be business as usual, but the jury is still out. One big thing to watch is what happens with Russia's exports from its east that typically go to Asia. Those could be disrupted.
All right, Bloomberg's Paul Wallace in Dubai. Thank you so much, and thanks for bearing with us through those technical difficulties. Now let's get back to the U.S. markets and take a look at some stocks moving in pre-market trading, and a lot of them actually tie back to the China story that we were discussing, the optimism around the reopening of that economy. That lifted Chinese technology shares in the Asian session, and it's doing the same in the pre-market session here in the U.S. when it comes to some of those ADRs. The likes of Alibaba and JD.com and Baidu all higher to the tune of 5% plus in pre-market trading. You also have the read-through into some casino operators that have big revenue exposure to Macau, and I'm talking 50 to 60% of revenue coming from that gambling enclave. Las Vegas Sands, Wynn Resorts, MGM, all higher to the tune of 2.5% to even 4% in the case of Wynn Resorts. The idea being that if you have easing of COVID restrictions, more travelers from the Chinese mainland can make it to Macau. Finally, a group of stocks moving lower today and just underperforming what we're seeing in the broader future session is large cap technology. The likes of Nvidia and Meta and Alphabet all down in the ballpark of about 0.5%. So the rate story obviously a big factor when it comes to some of those high multiple technology stocks, Anna.
Absolutely. We'll certainly keep an eye on those tech names then, Kailey. When we come back, we will be talking to Felix Zulauf later in the program, founder and CEO of Zulauf Consulting. What does he make of the China reopening story? What opportunities are within that? We'll talk to Felix about his thoughts. We'll be speaking with the founding partner of crypto venture capital firm 1KX. That conversation keeping the crypto theme going. This is Bloomberg.
Welcome back to Bloomberg Surveillance, the early edition. I'm Matt Miller with Kailey Leinz here in New York. Anna Edwards with us out of London. I am looking at the real Fed funds rate. Now, you could quibble about the definition, but generally the Fed considers the core PCE the most important measure. So if you take the Fed funds rate and take out the core PCE, we're only 98 basis points away from going positive on the real Fed funds rate, and Powell has said he wants to have this rate positive in order to fight inflation. So that's basically 2 meetings away, right? If they do 50 basis points at each one. The problem is if you look at CPI, then it gets a lot more negative. In any case, let's bring in Simon White right now, Bloomberg macro strategist, to talk to us about how this is going to play out. Because at the same time, Simon, right, it does look like we've hit peak inflation. So that number, CPI or PCE, is going to get smaller and smaller.
Yeah, for sure. I mean, I think that's certainly true. I think we're seeing peak inflation probably globally as well as in the US. And you know what? If Powell's looking for an out, and he wants to basically curtail rate hikes, he can point to the measure you just put there to show that it's back to almost flat. But I mean, is that the inflation rate that people are really paying? Probably not. You know, even headlines probably underestimating inflation. A lot of people are actually paying. And is he done enough to really snuff out inflation completely? No, I don't think so. I think it's going to be like the 70s. It's going to be a much longer play, if you like, the play in 3 acts. And I think we're just coming to the end of the first act. The second act is like the early ending of the alarm, and then the ease too early, and actually inflation comes back a lot higher later in the cycle.
Okay, a story in many acts, and we're only part way through, Simon. So if he wants an out, you suggest that could be where you find one, of course. Markets are still digesting, perhaps, what we saw on Friday with the jobs report and another hot number. Month after month, we seem to get these numbers that come in higher than expected. I spoke to one guest earlier today from Union Bancaire Privé who was saying that he found areas of weakness, just cracks in the labour market story out of the US. The weakness in the hours worked, some data from the household survey, all of that, he said, showed some weakness. Do you buy that, or do you think it is still an unashamedly strong jobs market?
I think there's a discrepancy here between jobs and people. So the establishment survey, which is payrolls, measures jobs, and the household survey, which is where you get the unemployment rate, measures people. And there's a big discrepancy. So I think there's been an extra 1.5 million or something like that jobs created this year versus new employees. And that's because a lot of people are getting extra jobs. So I don't think that's necessarily a sign of economic strength. I also think it means that you're going to see a deterioration in payrolls much quicker than you are than the unemployment rate. And so if the Fed is paying attention to the unemployment rate, they're actually going to be lagging the cycle, and therefore the Fed pivot, when it happens, I think could happen sooner than the market expects and also be much deeper than the market expects.
Okay, many definitions of real rates and inflation, many definitions of what's going on in the labour market then, it would seem, depending on the data you look at. Simon, thank you. Bloomberg Simon White with the latest on the markets. And for more market analysis, check out MLIV Go. That is the function to use on your Bloomberg terminal. That's where you'll find the Markets Live blog. This is Bloomberg.
This is Bloomberg Surveillance Early Edition. I'm Kailey Leinz with Matt Miller in New York and Anna Edwards in London. Now keeping you up to date with news from around the world, here's the first word. The founder of the collapsed investment firm Archegos Capital Management wants fraud charges against him tossed out. A lawyer for Bo Wang accuses U.S. prosecutors of engaging in deceitful conduct in the early days of the government's probe. A motion to dismiss the indictment against Wang says he was duped into assisting the government. He is set to go to trial next October. In South Africa, lawyers for President Cyril Ramaphosa are preparing a court challenge against an advisory panel report that said there may be grounds for his impeachment. At issue is the way Ramaphosa handled the theft of at least $580,000 at his farm. A spokesperson for Ramaphosa says he will not quit and will seek a second term as leader of the governing African National Congress. In the UK, the Rail Workers Union has rejected an offer aimed at ending a strike action plan before Christmas. Workers would have received 4% pay hikes this year and next, but the RMT union says that was conditional on a number of changes, including job losses, reducing staff on board trains, and closing all ticket offices. And the founder of failed crypto exchange FTX says he will testify before a House committee holding hearings on the matter. But Sam Bankman-Fried won't commit to when that will be. He says he has first to learn and review what led to his company's implosion. And of course, Anna will have more on crypto later on in the show. But first, we have to talk about the broader market picture.
Yeah, we do. We'll talk to Felix Zulauf, who's the founder and CEO of Zulauf Consulting. What does he expect to see in terms of the inflation trajectory, commodities, the US dollar? What's his strategy? This is Bloomberg. This is Bloomberg Surveillance Early Edition. Here's what you need to know. Backing away from COVID-0, China eases testing requirements in major cities across the country. OPEC and its allies hold steady. They decide to keep oil output unchanged in the wake of market turmoil and uncertainty. And Saudi Arabia's Crown Prince Mohammed bin Salman reportedly is set to invest in Credit Suisse's new investment bank that has shares rising in early trading. I'm Anna Edwards in London with Matt Miller and Kailey Leinz in New York. And Matt, it seems that mining companies, basic resource stocks and energy markets are kind of convinced by the reopening story out of China. Other assets, though, not so much.
Yeah, well, you could look at it that way. The other thing that I read on the Bloomberg this morning is that other markets may really just be taking their signals or basing their decisions on the Fed rate path rather than the increased demand that would come from a reopened China. It does look like that's what S&P futures are doing right now, down about 0.5%. It should be said that the reason everyone is once again concerned about the Fed rate path is that we got such a strong jobs number and such a strong wage increase in terms of average hourly wages on Friday. And then at the end of the day, the equity index didn't finish much lower at all. I think only about 0.1% down on the day, 1 or 0.2%, still above 4,000. So it does look like over the weekend, as more economists have come out, including Larry Summers, and said that rates may need to be higher than the market is currently pricing in, investors have decided to sell futures. The U.S. 10-year yield also rising a little bit, about 3 basis points right now to 351.51, and economists and strategists have also said that this number needs to be much higher if we're going much above 5 on the terminal rate as well. NYMEX crude, on the other hand, as you said, getting its cues from the reopening moves that we're seeing in China, or at least the loosening of rules that we're seeing in China. That could boost demand. So we're up to 81.43 a barrel. A week ago at this time, we were down at the 73 handle. So it's a pretty significant climb. And then speaking of significant climbs, Bitcoin now back up over 17,303. Obviously, there's still a lot of fallout to come from the implosion of FTX, maybe another shoe to drop in terms of more bankruptcies. Nonetheless, the underlying asset doesn't seem to have been hit as hard by the problems in those centralized exchanges. Kailey, what do you see in terms of the pre-market movers?
Well, a lot of them come back to the China story we were talking about, the optimism about the reopening of the economy. We saw big gains in Asia overnight for that very reason, and that is trickling through to some of those big Chinese technology companies that are listed here in the U.S. The ADRs of Alibaba and Baidu, for example, and JD.com all higher by about 5% in early hours. The other group of stocks moving significantly higher, far outpacing what we're seeing in the broader market, is casino operators, because of course the likes of Wynn Resorts and Las Vegas Sands and MGM all have heavy revenue exposure to Macau. It makes up in some cases more than half of overall sales. So as a result of the idea that more Chinese mainland travelers can go to Macau and gamble, it's lifting the likes of Wynn Resorts and Las Vegas Sands by 3 to 4% each, Anna.
Yeah, so clearly the China reopening story having an impact there, Kailey. Here in Europe, it does have a bit of an impact when it comes to the basic resource stocks, the mining companies. They're all trading higher today, and that limits the downside perhaps, but the downside winning out just, and we're down by 0.1% or so on the European markets on the Stoxx 600. Brent crude, Matt's already been through the WTI story, up by 1.8% here as well. 87.11 is where we trade on Brent. There's OPEC deciding to wait and watch and just keep an eye on what's happening in this market. There's a lot changing with the China reopening story. On the other hand, Europe saying it doesn't want, of course, any seaborne cargoes of oil from Russia, and it puts a cap on the price of that oil for the purposes of European insurance and for transportation. So that's a complicated story. And our contacts, talking to our colleague Maria Tadeo in Brussels, saying you just have to wait and see how this is going to play out. The natural gas price up by 2.8%. And I put this in as an excuse really to talk about the deal between Trafigura and the German government. It's an interesting one. The German government doing its own deal with the energy trading business Trafigura. And this means that they are going to be, Trafigura benefits from a loan backed by the German government. And in exchange, they agree to supply substantial amounts of their US LNG supplies to Germany over the months and the years ahead. Credit Suisse is up by 6%. We mentioned in our headlines that there's been this other reporting in the media around whether Mohammed bin Salman is going to make his own investment in the business. We know that broader Saudi infrastructure or bodies are going to be making an investment. Whether he will also be adding his name to the investment roster, if you like, those anchor investors, is a crucial one to watch there, Matt.
All right, we'll definitely keep an eye on that. And speaking of Swiss banks, let's talk to Felix Zulauf right now. He's the founder and CEO of Zulauf Consulting, has been for decades a member of the Barron's Roundtable, and also used to work at some Swiss banks in a number of different cities around the world. Felix, great to get you on the program. Thanks so much for joining us. Let me first get your take on what we saw on Friday here in the U.S. in terms of the non-farm payrolls number, and especially the increase in average hourly earnings. What do you think this means for the Fed and indeed other central banks that need to take their cues from the Fed in terms of a terminal rate higher than 5? How much of a problem is that for global markets, for risk assets?
Well, obviously, the U.S. is in a very special situation because the U.S., like no other country, has still a fiscal pipeline that has nourished the consumer, that the consumer can hold out much longer. And that's the problem for the Fed. Obviously, the Fed has increased and hiked rates quite aggressively, and that is impacting all those rate-sensitive sectors like housing and automobiles and things like that. But the demand has jumped over to the service sector. And if they want to kill the service sector demand, then they have to go much higher. I do believe, however, there is a global influence of the US economy. And I think the world economy is in much weaker state than the US. And that will remain the case. Maybe the US will have a mild recession in the middle of next year. But I think Europe and China, they are in a very serious and severe recession for the first half of next year. So I think the Fed has to probably watch what's happening in the other parts of the world because they cannot overdo it. There are too many problems on the financing side in many countries around the world with too strong a dollar.
Okay, so you think the rest of the world is looking at potentially a more severe recession than the U.S. economy, and yet there is this narrative in markets that the Fed is going to be forced to pivot back toward easing at some point, that economic forces are going to mean that they turn the other way. When do you anticipate that will happen, Felix?
I think only once we see the U.S. economy clearly weakening, and I do not expect that before the second quarter. So I think the first quarter will be a big disappointment because you won't see the pivot people are expecting. And that's why I think the markets will have another sell-off in the first quarter and then probably complete the cyclical correction that we announced about a year ago or so.
Okay, so you think that we have further to fall. So where will you be looking for the entry point, Felix? What signal are you looking for?
Well, the ideal thing would be a credit event sometimes somewhere in the world. And obviously China is a big candidate that we have credit events in China that would rock the world because China is so important. And I think that would signal the Fed that it has to go slower, and that would give us the pivot that many are looking for.
Let me ask you about what's going on with the dollar, Felix, because one of my colleagues brought to my attention a chart that showed the Bloomberg dollar index has actually erased 50% of its gains from 2022, which suggests we've seen quite a retrenchment in that strong dollar story already. Are you buying that? Do you expect that to continue?
I think what we have seen is a short-term correction, and we will probably see a big bounce in the first quarter, close to the highs that we have seen before. That would then probably most likely complete a top, and then the dollar could decline for the rest of the year 23. But I think from here it's not much down. We have corrected quite a bit, and the market is getting very oversold. And I think there will be a disappointment in the credit markets, because I do believe that the bond market yield has declined a lot. And there are huge amounts of treasury issuance ahead of us. And there is, the normal buyers, they are full already. They have allocated their amounts. And there are strong sellers. There is the Treasury is a big seller. The central bank is a big seller. Foreign central banks are a big seller. And therefore, I think we will have a swing back in the bond yields in the next few weeks.
Okay, is that going to weigh on demand for corporate debt then? Is that the link you're making?
Well, it affects also the corporate sector. The corporate sector has been borrowing quite heavily recently in different regions of the world. But I see that rather as financing higher prices in their working, and also financing increasing inventories, which are accumulated in an involuntarily way. So I think the corporate credit demand will loosen up once we will see that the final demand is beginning to weaken somewhat after the Christmas season.
Felix, I want to get your take on China. It had been called quite often this year uninvestable. On the other hand, investors are almost as excited about the reopening of China as they are about the possible pivot of the Fed. Is it going to happen? Do we see it happening right now? And is China, you think, a must-have for institutional investors in their portfolios?
Well, China is loosening some of the restrictions, and that will over time have a beneficial impact. But what China cannot do, and I think where most of the analysts and economists are wrong, is that China cannot stimulate the economy dramatically, because there are boundaries, and the boundaries are primarily their balance of payment system, and particularly the banking system. The credit system is not in a position to finance high growth. The high growth of recent years, before they slowed down, was really at the margin foreign funding. And the Chinese do not want to depend more on foreign funding, and they are actually even trying to pay back US dollar denominated debt. And therefore, the Chinese are not in a position to really go full speed in stimulating the economy. If they did so, we would have a serious currency crisis like in 94 or so, where the renminbi would plunge sharply, and where it could trigger off a major crisis in Asia. And I think China does not want to do that, because it could backfire in trade and backfire also in politics.
Okay, so you don't think we're heading there. Felix, thank you very much. Thanks for joining us. Felix Zulauf of Zulauf Consulting. Coming up on the program, Lasse Clausen joins us, founding partner of crypto venture capital firm 1KX. What kind of appetite is there for putting money into crypto startups right now? We'll talk about that next. This is Bloomberg.
This is Bloomberg Surveillance Early Edition. You're looking live at the principal room. Coming up later today, an interview with Senator Bill Cassidy, Republican from Louisiana. That's at 7:30 a.m. in New York, 12:30 p.m. in London. This is Bloomberg.
I mean, there were explicit mechanisms by which there was allowed borrowing and lending on the platform. But I completely agree that it is in general, like a huge warning flag. And I thought that we had, processes in place that were managing it. I didn't do nearly as much diligence on that as I should have.
That was Sam Bankman-Fried speaking in an interview that aired on ABC this week yesterday. Meanwhile, Bankman-Fried says he will testify before Congress once he has finished learning and reviewing what happened. He says he's not sure that will happen by next week when the chair of the House Financial Services Committee invited him to join a hearing scheduled for the 13th. Joining us now to discuss more of the FTX fallout and the latest in crypto is Lasse Clausen. He is founding partner of 1KX, which is a crypto venture capital firm. Lasse, thank you so much for being with us. Clearly, we continue to see the ripple effects of the downfall of FTX. How has its collapse affected your portfolio companies?
Hi, everyone, and thank you very much for having me. So I think we had a stronger overall market reaction in the spring when we had the first shakeout of some, under-collateralized centralized finance players. I think the FTX story on top hasn't had that much effect overall. Also on prices, I was actually quite surprised that with a calamity of this magnitude, that Bitcoin didn't go down to 5,000. So overall, FTX fallout on prices hasn't been that dramatic, and then particularly on our portfolio has been very, very limited. We did a survey, we talked with our portfolio company, and none of them was actually directly involved. One of them used to have Alameda as a market maker, but the relationship had already ended.
Okay, and last, one thing we know is that FTX drew in big venture money. And I'm wondering, as a venture capital investor, how this may change your thinking about what you want to invest in and, frankly, how you conduct due diligence in this space.
Yes, so I want to, tread lightly here, but there were some very, very obvious warning signs about FTX Alameda from day one. We looked at this back in the day, and, you didn't have to dig too deep to basically know that half the team was a hedge fund that was trading on its own exchange. So that's already a huge, warning sign. And so, we and a lot of other earlier sort of crypto investors abstained from investing in FTX. I think overall, and how it affects our portfolio and our way that we make investments. So I would say actually not at all, because what is very, very important, I think, to differentiate that FTX itself wasn't in effect really a crypto business. FTX was just a normal exchange, centralized exchange. We've had this business model before that happened to sell digital asset, but it might as well have sold, soybeans or, stocks. In our view, really the innovation of crypto and of blockchain is computer, internet, software infrastructure that is completely open source. Now, what does that mean? That every single line of code of the entire system is completely transparent. Anybody can at any time see what is the logic, what are the possible operations. You get mathematical guarantees that operator fraud is impossible the way it is. The way that it happened with FTX is technically impossible in the kind of systems that we invest into. And on top of that, you have 100% transparency. So at any moment, anybody in the world can verify where the funds are and if they're moving or not. So we continue to invest heavily in that. We believe, and actually, you can make the point that FTX is another endorsement that we actually need these systems where you don't need to trust people or institutions. You just need to trust the math.
Lasse, what do you think about the the state of regulation in the U.S.? I mean, since the implosion of FTX, we've heard a number of people come out and say you could run this business in the U.S., on traditional regulation. You can't commit fraud here, and you shouldn't do it in the Bahamas as well.
Yeah, so I think, there was also a very obvious thing that FTX didn't get audited, right? So that's a big one, that you just have, reputable third-party auditors once a year. And I think overall, the traditional centralized businesses, such as centralized exchanges, but I also think centralized stablecoin issuers, I do think they need to be regulated. So in our view, if it's not open source, it doesn't need to be regulated. So sometimes the industry gets the reputation that, it's very anarchist and nobody wants any type of regulation. We definitely very much look forward to, specific modernized regulation that covers particularly centralized exchanges and stablecoin issuers, because, those have or propose systemic risk. And for the industry to move forward and regain the trust, we do need regulation.
If that's the case, Lasse, good morning to you. Why does so much of the business want to locate in areas that seem to be off the beaten track or off-piste in some way? You know, in parts of the Caribbean, maybe in low-tax jurisdictions. If regulation is not such a threat, then why doesn't the industry just come and locate in London and New York?
Yeah, so I think at this point you don't have regulation. You basically have a gray area, and everything is up to the interpretation / jurisdictional sort of land grab of the two main regulatory bodies. Mainly the SEC has been doing that more through selective enforcement action. And so what happens is that you basically need to build individual relationships with the regulator. You need to have meetings, but in the whole process, you don't have any certainty of what the outcome is and what the actual risk that you're taking. And if you think about it as an entrepreneur, the hard part is actually creating a product that is valuable and useful to users. You can't spend 95% of your energy on, working out with regulators whether, this individual piece of your product will be allowed or not.
Lasse, great having you on the program. Hope we can get you back soon. Lasse Clausen there of 1KX talking to us about crypto. Tune in, by the way, to our dedicated Bloomberg Crypto program. That's every Tuesday at 1 p.m. New York time, 6 p.m. in London. It's our weekly show that covers the people, the transactions, and the technology shaping the world of decentralized finance. This is Bloomberg. This is Bloomberg Surveillance Early Edition. I'm Matt Miller with Kailey Leinz here in New York. Anna Edwards with us out of London. Now, Mike Wilson of Morgan Stanley has seen enough of the recent rally he predicted. Joining us now with more is Kriti Gupta in London to explain why he says he is a seller again. So we give him credit for predicting this rally, Kriti.
Well, he's been a bear for quite some time, and even the rallies that he has predicted, he said they're bear market rallies. This is not really indicative of some sort of long-term turnaround. And here he is bearish again, saying this time the trigger for that was simply the S&P 500 bouncing off of its 200-day moving average. This is significant because if you put it into context, what's important about Mike Wilson's call is that he said actually there would be some sort of pivot just a few weeks ago between this kind of macro Fed-driven story to the earnings picture. But as he saw that weaker corporate earnings story, he really changed his tune.
Well, what's interesting, Kriti, is he was lonely for a decent part of this year in being such a bear, and now it seems like everyone has come on over to his camp. It's not just him that is predicting more declines in the first quarter of next year.
Well, he's been lonely for a couple of years, Kailey. Remember, he was the most bearish of them all on Wall Street. But to your point, yeah, he's now really out in front, and he is coming and leading the consensus story. Binky Chadha over at Deutsche Bank is just one example of that kind of story where they're saying there could be a little bit of a bounce going into December. Call it a Santa rally, if you will. But even in 2023, we are still headed for more pain in the equity market.
Ties in with the conversation we were having with our guest, Felix Zulauf from Zulauf Consulting earlier on. Kriti, thank you. Interesting to see European stocks, and good to see you in London, by the way, including dividends, are back to pre-Ukraine war levels, which is an incredible bounce back for European stocks. And even if you exclude those dividends, we're not far away from bouncing back to those pre-war levels. Thank you very much to Kriti Gupta for joining us on set here in London. That is it for Early Edition. Surveillance is still ahead. We'll hear from Ron Temple of Lazard Asset Management, among others. They'll get you set up for a busy week of data this week. This is Bloomberg.